In today's economic landscape, credit card debt has become a pressing issue for Americans. And now, looking at the total bill of $1.14 trillion dollars, or roughly $8,000 per American, the alarming trend has continued when we see record high interest rates, including record high balances, which is causing more Americans to default on their payments and also max out their credit limits, having a huge impact on their credit score. Now, this is a major problem in America when it comes to credit card debt, and working in a financial institution and doing the financial education and financial counseling, we are seeing this as a crippling effect for Americans. When you start looking at the perfect storm of the credit debt accumulation that we're seeing in this nation, the Federal Reserve has shown and has started to move those rates down. We are still seeing people that are overrun by debt. For a lot of Americans, this poses the question, how do you reduce your credit card debt without debt settlement? Now, of course, this is going to keep that credit score intact. And I want to go through a couple different ways that we can do this to actually repay your debt. Now, the first one, and the biggest caveat to this, is you have to stop using the cards. That is the biggest one, regardless of any method that I share with you that you utilize. You have to stop using the card. It is what is going to continue this perpetual debt cycle, and it will never end until you stop using the cards themselves. Now, the first one we look at is transferring your balance. Now, of course, many credit card issuers will offer that 0%. It is a big introductory rate, and a lot of people do go for it. We've seen them for 12 months, 18 months. We have even seen some 0% for 24 months. By transferring a high rate credit card, when we look at 22, 25, 30%, moving that rate to a much lower rate really can help you pay it off, which again, if you're not accumulating new debt on that card, that is going to be the game changer. This, of course, with your regular payment is going to reduce the balance owed much faster because you are paying that 0%. Now, the pros of this, you can save a ton of money on interest. And of course, you're paying that principal much quicker because none of it is going towards interest. If you have, let's say, for instance, a $250 payment, move it to a 0%, continue making that $250 payment. You're going to be really going through a lot of interest on that card if you stick with the same payment. What I see a lot of times is people will transfer the balance. All of a sudden, they want to make the new much lower payment because it's only interest. And of course, the balance isn't moving as fast as they can. Now, the big con with this, when it comes to pros and cons, is there usually is a balance transfer fee. Some companies charge 3 to 5% of the transfer amount. So if you're transferring over $10,000, they are going to charge you 3 to 5% up front. That is going to be the fee to do that. And of course, if you don't pay it off by the end of the promotion period, if it's a 12 months to 18 months, you are going to have to be stuck with the highest interest rate or whatever interest rate they're currently offering on this card. So what is it the best option for? Who does this really fit? This is the best option for individuals that have incredibly strong credit. If you have poor credit, a lot of times balance transfers are not going to be available. They want individuals that they know are going to make the payments. And of course, that is how it really works. Now, the better option to this is consolidating your debt. Now, we do a lot of debt consolidation. This is taking a multitude of credit cards. Let's say, for instance, you have 10 different credit cards, taking all of that high interest debt, rolling it into one single loan that has a much lower rate. But again, with this consolidation method, it is the exact same. You cannot accumulate and continue using the credit cards when you do the consolidation. This, of course, is going to simplify your payment to one rate, to one payment, but it's also going to make it a little bit more affordable. And the interest rate on a lot of consolidation loans are a lot faster. Now, of course, the pro of this one, you get a lower interest rate on all of the debt that you have, and you have a monthly payment that you can manage. Now, of course, if you want to get out of debt faster, you can go ahead and pay this down a lot faster, eliminating it. Now, another thing that we also see is with a lot of debt consolidation, not only racking up additional debt, is some people are taking out consolidation loans for an extended amount of time. Really, if you're doing a consolidation loan and thinking about paying this off, 24, 36 months, so 2 to 3 years to consolidate this, pay it off, while not accumulating any new debt. What I see individuals do is taking these loans out for 5 years, 6 years, 7 years on a consolidation. Chances are within that time frame, you might have additional expenses or you might have additional debt, which is what people usually accumulate. Now, the cons of this, you have to qualify for loan. Of course, this has really two big factors. Number one being your credit score. The second one on here is your debt to income ratios. We are getting to a point as Americans where the debt is getting so high, the monthly payments are getting so high. A lot of individuals are not qualifying for consolidation loans because of the debt to income ratios, because again, those credit card balances are too high. So who is this the best option for? Borrowers with good credit, excellent credit, definitely qualify for a lower rate. But of course, you do have to qualify debt to income ratio as well. With people and individuals with poor credit, chances are some of these loans might be at about the same rate. We see them at 18, 20, 22% when it comes to consolidation loans with poor credit. Now, the fourth one we get into is enrolling in debt management. These are plans that are specifically designed to pay off your credit cards over time. Really more of a credit counseling agency. When I think of like Green Path, there's a couple out there that not only lower interest rates, but reduce fees. This is kind of a hands-off approach. This is an approach that I do not like because my education, I'm doing the financial counseling. I can do the same thing as a debt management company, negotiating with creditors with the individuals present. I can do the same thing and I don't charge you a fee. You have to be very cautious with this. A lot of different places will charge you 5%, 10%, 15% as a fee that they're charging for them to manage your debt. You, again, don't want to do this. It's very expensive and it is something that you can do on your own. Now, the pros of this, you can get a lower interest rate. You can also get a lower payment. So some debt places will actually pay off some of your debt to transfer it. They are now pretty much your lender. So you are paying them for the debt settlement. And of course, you have the support of a credit counselor to go ahead and guide you. Now, the con of this, there could be a lot of fees. You could see upfront fees, you could see percentage fees, and it may also take several years to knock out this debt, where you could do it again a lot faster. Now, one thing with this, another con is majority of times they close your credit cards. They'll close your credit lines, they'll close out those credit cards, which of course in short term could lower your credit score. But also if you're an individual, and I do not recommend it at all, that relies on credit cards for that emergency fund because you haven't built it up yet. A lot of people will start just opening new cards. Now, of course, this is for individuals that are not very organized with their payments, and they do want to try to negotiate better terms, but they don't want to do it on their own. And of course, my favorite, the DIY credit negotiators. That's right. You can contact your credit card companies, and not many people know this. You can negotiate for a lower rate. You can go ahead and get a higher limit. You can get a lower rate. You can even settle some of your debt for less than you owe. There's a lot of different ways that they can do. If successful in this methodology, you can lower your payment, reducing the interest rate, also really warding off the negative credit impact. The credit card companies want to get paid. That's it. Even if they get paid a little bit less, a lot of the companies are okay with it, especially from very, very good customers that have paid them for an extended amount of time. Now, of course, the con, creditors might just say no. A lot of them within a rising rate environment, which now we're getting to the point where you kind of are seeing rates go lower. But of course, they can just flat out say no if you don't have, and honestly, you don't have any negotiating room short of just, staying on top of your payments, not paying as much interest by paying down the balances, and also not paying any fees. Now, of course, this is really confident on you and making sure and building the accountability for yourself. When it comes to this option, it is all about you. It is about doing everything yourself. So the bottom line here, guys, debt can be super overwhelming. You have a ton of different ways that you can manage it, but of course, living within your means and really focusing on building and eliminating that debt, getting to the debt-free journey by managing and budgeting properly is the biggest way that you can really get this to align with your financial goals. Thinking big picture, being debt-free involves a combination of strategy, patience, time, and commitment to changing that financial mindset. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think, and I'll catch you in the next video.